Disclaimer.
Hello, friends. I'm delighted to be back with you in this new installment on silver. More and more of you are following me, which gives me courage and fills me with energy to bring you content on the financial markets. That would make America go away? Boycott has officially hit the one place it hurts most, the plumbing of the silver market. Right now, European dock workers are refusing to unload American ships, and the world's top 50 CEOs have reportedly begun a silent withdrawal of capital from the U.S. financial system. But here is the terrifying reality. Silver didn't crash because people don't want it. It crashed because the banks are terrified that they can no longer find it. On Friday, silver hit $122 and was violently hammered back to $84 in a desperate liquidation trap triggered by the Kevin Warsh nomination. When Warsh emerged as the surprise nominee to lead the Federal Reserve, the dollar index, what traders call the DXY, staged one of the most violent rebounds in recent memory. This created a ripple effect through every leveraged position in the commodities market, and silver, being one of the most heavily leveraged trades on the planet, got obliterated. They want you to panic sell your physical metal back to them before the market opens tomorrow. Because on Monday at 9:30 a.m., the paper market and the physical world are about to collide. If you see these 5 signs on your screen, it means the Comex is effectively dead, and the price you see is a lie. Asian consumers, particularly in China and South Korea, have joined this coordinated effort to isolate American commerce. This goes beyond tariffs or negotiations. This is economic warfare that is creating a paradox that should be impossible in normal markets. The paper price of silver is crashing, while physical demand is absolutely exploding. Think about what that means for a moment. When people want to buy something and can't get it, prices go up. That's economics 101. But in the silver market right now, we're seeing the opposite. The price is falling while buyers are literally fighting over physical metal. How is that possible? The answer lies in understanding the difference between paper silver and real silver. Most of the silver traded in our markets doesn't actually exist. It's contracts, promises, digital entries in a ledger. The London Bullion Market Association and the Comex in New York handle the majority of global silver trading, and they operate on what's essentially a fractional reserve system. For every ounce of actual silver in their vaults, there are dozens of paper claims on that same ounce. This works fine as long as most people never demand actual delivery. It's like a bank. As long as everyone doesn't show up asking for their cash at once, the system functions. But what happens when the supply chains that feed physical silver into this system start breaking down? What happens when dock workers in Antwerp refuse to unload American shipments? What happens when Chinese buyers who used to purchase U.S. electronics start hoarding silver instead? You get a liquidity squeeze, not the kind where prices go up, the kind where the paper market starts collapsing under its own weight while the physical market goes into hiding. Sellers who need to cover margin calls are dumping paper contracts at any price. Meanwhile, anyone trying to buy actual physical silver is discovering that premiums have gone from $3 or $4 over spot to $15 or $20. In some markets, you simply can't get it at any price. This creates an opening for something most retail investors have never considered: the exchange kill switch. The CME Group, which operates the Comex, has a weapon in its arsenal that they can deploy without warning. It's called a margin requirement increase, and what they did on Friday afternoon should terrify anyone holding silver positions over the weekend. They hiked margin requirements by 47%. Let me explain what that means in plain English. If you're trading silver futures or options, you have to put up a certain amount of cash as collateral. That's your margin. The exchange can change this requirement whenever they deem markets too volatile. A 47% increase means that if you had $100,000 securing your positions on Thursday, you now need $147,000 by Monday morning. If you don't have that cash, your broker will liquidate your positions automatically. Now, here's the ugly part. Do you think retail traders got a heads up about this margin hike? Do you think the algorithmic trading firms and the big bullion banks got caught off guard? Or do you think the smart money knew this was coming and positioned themselves accordingly? The timing is devastating. Thursday's flash crash already wiped out weak hands, traders who had stop-loss orders that triggered during the panic. Friday's margin hike is designed to finish the job. It will force even more selling when markets open Monday, driving the paper price even lower. This is not market dynamics. This is market manipulation designed to protect institutions that are trapped on the wrong side of history. See, there's something most investors don't know about the silver market. The big banks are short. They've been short for years. Being short means they've sold silver they don't have, betting that prices will fall so they can buy it back cheaper and pocket the difference. It's a profitable strategy when you can influence the paper price through derivatives and when physical supply is not an issue. But what happens when physical supply becomes an issue? What happens when delivery demands spike? What happens when the ratio between paper claims and actual metal becomes so absurd that the whole system threatens to implode? You get Friday's margin hike. You get emergency measures designed to freeze out retail accounts before the banks get caught in a squeeze they can't escape. You get a system that's supposed to be about price discovery instead becoming about price management. And this is all happening while our government is imposing the highest tariffs since 1946. 14% across the board on imports. You know what that does? It makes everything more expensive. It pushes inflation higher. It makes people question the purchasing power of the dollar itself. And when people start questioning the dollar, they look for alternatives. Historically, that means gold and silver. So we have multiple forces converging at once. A viral global movement turning into economic blockades. A paper market that's mathematically insolvent. Emergency margin hikes, designed to protect institutional short positions, and tariff policies that undermine confidence in our currency. Any one of these would be significant. All of them together create a situation we've never navigated before. Monday morning, when Asian markets open, which is Sunday night for us on the East Coast, we're going to see whether this system can hold together. The question isn't whether silver is worth $83 or $121. The question is whether the price discovery mechanism itself still functions. The question is whether exchanges can continue to promise delivery on metal they don't have while the world outside their walls stops playing along with the fiction. You need to understand something crucial. This isn't about whether silver goes up or down. This is about whether the market for silver remains orderly or breaks into two separate markets, one for paper promises and one for physical metal. And if that happens, if we see a complete decoupling, then the number on your screen becomes increasingly irrelevant compared to whether you actually hold the metal or just a claim on metal that might never be honored. The next 48 hours will tell us whether the largest silver market in the world can survive the pressure, whether the institutional players who have controlled this market for decades can maintain control when the rules they have written suddenly don't match reality on the ground, whether American investors will have access to physical metal when the system they have trusted turns out to be built on sand. This is where we are. This is what's at stake. And this is why Monday morning might be remembered as the day the silver market changed forever. Now, I know what some of you are thinking. This sounds dramatic, maybe too dramatic. Banks manipulating markets, exchanges changing rules mid-game, global boycotts turning into financial weapons. It sounds like the kind of conspiracy theory your uncle shares on social media. So let me show you the raw numbers, the institutional movements, and the structural crisis that proves this isn't theory. This is mathematics. Let's start with the Comex itself. The commodity exchange in New York is supposed to be where price discovery happens for silver. It's where futures contracts are traded, where hedgers manage risk, where the official price of silver gets established for the entire Western world. But here's what the exchange doesn't advertise. It operates on a fractional reserve system that would make any bank regulator nervous. The Comex divides its silver inventory into two categories. There's eligible silver, which is metal sitting in approved warehouses that meets quality standards but is not specifically allocated to any contract. Then there's registered silver, metal that's actually pledged against active delivery obligations. This is the silver that matters when contracts come due. As of the most recent report, the Comex has approximately 30 million ounces in the registered category. 30 million ounces sounds like a lot until you understand what's coming in March. The exchange is currently carrying delivery obligations for over 500 million ounces in the March contract alone, 500 million ounces of promises against 30 million ounces of actual metal. That's a 20-to-1 ratio. Let me put that in terms anyone can understand. Imagine your bank has $100 in its vault, but has promised 20 different people they can withdraw $100 each. As long as those 20 people never show up at the same time, the bank looks solvent. But what happens when even a handful of them demand their money? That's where the Comex stands right now. And March is when those demands are scheduled to arrive. According to the exchange's own data, open interest in March silver futures has been climbing steadily over the past 6 weeks. These aren't speculators rolling positions forward. These are delivery demands from entities that want actual metal. Now, historically, most futures contracts get rolled forward or closed with cash settlement. Maybe 95% of contracts never result in physical delivery. The system depends on this. But what happens when that percentage changes? What happens when 10% demand delivery instead of 5%? Or 15%? Or 20%? The math becomes brutal very quickly. If even 20% of March contract holders demand physical delivery, we're talking about 100 million ounces. The Comex currently has registered inventory of 30 million ounces. Where do the other 70 million ounces come from? The exchange has three options: find more silver, convince people to accept cash settlement, or declare force majeure, which is a fancy legal term for we can't fulfill our obligations. And here's what should terrify anyone paying attention. The Comex knows this. The big banks trading on the exchange know this. The regulators watching the exchange know this, which is exactly why we saw Friday's emergency margin hike. They're trying to shake out as many contracts as possible before March delivery period arrives. But let's zoom out from New York and look at what's happening globally, because the inventory crisis at the Comex isn't happening in isolation. Remember that Make America Go Away movement we talked about? It turns out this isn't just hashtag activism or viral videos. This is official policy in multiple jurisdictions. The European Union has deployed something called the anti-coercion instrument. This is a formal mechanism that allows the EU to impose countermeasures when it believes a third country is using economic coercion. In plain English, when the EU thinks America is bullying them with tariffs or sanctions, they can hit back with their own restrictions. And they're using it right now. European companies have been advised to diversify away from dollar-denominated contracts. European ports have been given authority to delay American shipments for extended customs inspections. European financial institutions have been encouraged to develop alternative settlement systems that don't route through New York. This isn't guerrilla economic warfare. This is coordinated policy from Brussels. And then there's BRICS, Brazil, Russia, India, China, South Africa, the economic bloc that represents about 40% of the global population. For years, they've talked about creating an alternative to the dollar-dominated financial system. In late January, they finally launched it. The unit currency officially went live for cross-border settlements between member nations. Here's what makes the unit terrifying for dollar hegemony. It's 40% backed by gold. Not promises, not bonds, not good faith, actual gold held in reserve. And when Saudi Arabia announced it would accept units for oil payments, the financial world should have stopped and paid attention. Because what just happened is that one of the world's most critical commodities now has a payment mechanism that completely bypasses the dollar. Think about what this means for silver. If oil can be purchased without dollars, if trade can settle without New York banks as intermediaries, then the entire justification for holding massive dollar reserves starts to crumble. And when countries decide they don't need as many dollars, they need somewhere else to park their wealth. Historically, that somewhere else has been precious metals. We're seeing this play out in real time. According to the World Gold Council, central bank gold purchases in the fourth quarter of last year hit levels not seen since the 1970s. And silver? Silver demand from institutional buyers has doubled year over year according to the Silver Institute's preliminary data. These aren't retail investors stacking coins in their basement. These are sovereign wealth funds, pension managers, and family offices that are quietly rotating out of dollar assets. But perhaps the most revealing indicator of stress in the silver market isn't the inventory numbers or the geopolitical positioning. It's something called the lease rate. And right now, the silver lease rate is screaming that the system is broken. Here's how leasing works in the precious metals market. Central banks and large holders of physical metal will lease it out to commercial banks and refiners who need it for actual operations. The lease rate is essentially the interest rate on borrowing that metal. In normal times, silver lease rates run between 0.5% and 2%. It's a sleepy, boring corner of the market that nobody pays attention to. Right now, silver lease rates have spiked to 8%. 8% is not normal. 8% is not even concerning. 8% is panic. The last time lease rates hit these levels was during the 2008 financial crisis, when every assumption about counterparty risk got thrown out the window. What does an 8% lease rate tell us? It tells us that the entities who normally lease out silver, primarily central banks, either don't have silver available to lease or they don't trust the entities trying to borrow it to actually return it. Either explanation is catastrophic for the paper silver market. See, the lease market is how the paper markets used to manage physical shortages. When delivery demands exceeded available inventory, banks would simply lease additional metal from central banks, fulfill the delivery, and return the metal later when they could acquire it cheaper. It was the release valve that kept the fractional reserve system functioning. But if that release valve is sealed shut because lease rates are prohibitively high, then there's no mechanism to resolve delivery squeezes. The Bank for International Settlements, the central bank for central banks, published a report in December showing that precious metals leasing activity has dropped 70% from peak levels. 70%. That's not a reduction in activity. That's the market essentially ceasing to function. And there's more. The London Bullion Market Association, which sets the global benchmark prices for precious metals, has been quietly warning members about settlement delays. According to industry sources who spoke to Reuters, some bullion banks have been asking counterparties to accept cash settlement instead of physical delivery, even on what are supposed to be guaranteed allocated accounts. When you can't get metal from an allocated account, an account where your specific bars are supposed to be sitting in a vault with your name on them, the entire premise of the market is in question. This is why Friday's margin hike matters so much. This is why the flash crash to $84 matters so much. The institutions running this market are buying time. They're trying to reduce exposure, shake out weak hands, and delay the inevitable reckoning when physical demand overwhelms paper supply. But here's what they can't control: the boycott. The dock workers in Europe aren't following orders from the Comex. The BRICS nations launching the unit aren't coordinating with New York banks. The lease rate spike is not a policy decision. It's a market signal that the old mechanisms have broken down. We are watching the convergence of multiple crises that were manageable individually but become catastrophic when they happen simultaneously. A Comex that's mathematically insolvent on delivery obligations. A global movement to bypass dollar-denominated trade. A lease market that's collapsed and can't provide the lubricant that kept the fractional system running. And a 47% margin hike designed to prevent retail investors from participating in what happens next. The proof isn't in conspiracy theories or speculative predictions. The proof is in the inventory ratios, the lease rates, the institutional movements, and the emergency actions exchanges take when they're terrified of what Monday morning might bring. The numbers don't lie. The question is whether anyone will listen before the system breaks completely. So let's do the math. Not the hopeful math or the theoretical math, but the cold, logical calculation of what happens when the forces we've discussed actually collide on Monday morning. Because this isn't about predictions anymore. This is about inevitability. We've established that the Comex has 30 million ounces of registered silver against 500 million ounces of delivery obligations for March. We've established that the lease market has collapsed, eliminating the traditional pressure relief valve. We've established that global boycotts are disrupting supply chains while institutional demand is accelerating. Now let's calculate what happens when these realities meet the market opening at 9:30 Monday morning. Here's the scenario that keeps bullion bank risk managers awake at night. What if just 20% of March contract holders demand physical delivery? Not 50%, not 30%, just 1 in 5. That's 100 million ounces of delivery demands against 30 million ounces of available registered inventory. The shortfall is 70 million ounces. Now, in a normal market, the exchange would simply go find more silver. They'd pull from eligible inventory. They'd source from refiners. They'd lease from central banks. They'd import from Mexico or Peru or wherever else silver gets mined. But we're not in a normal market anymore. Eligible inventory is already being quietly moved to registered status, and it's still nowhere near enough. Refiners are reporting that their forward order books are full for the next 6 months. The lease market is frozen at 8% rates. And those Mexican and Peruvian shipments, they're sitting on docks in European ports that aren't unloading American-bound cargo. So what's the exchange's option when they can't fulfill delivery? They declare force majeure. This is the clause in every futures contract that says if delivery becomes impossible due to circumstances beyond the exchange, as control, war, natural disaster, civil unrest, or in this case, a complete breakdown of the physical supply chain, they can settle contracts in cash at whatever price they determine is fair. Think about what that means. You bought a futures contract because you want actual silver. You're entitled to delivery of actual silver. But the exchange says, sorry, we can't deliver silver, so here's cash instead. And not even cash at the current market price. Cash at whatever the settlement committee decides is appropriate. This has happened before in other commodity markets. It happened in palladium. It happened in certain oil contracts during negative price spikes. But it's never happened in silver on the Comex. If it happens Monday, if we see a force majeure declaration, or even rumors of one, the psychological impact will be nuclear. Because here's what happens. The second that force majeure rumor hits the wires, every single holder of a March contract who can demand delivery will immediately demand delivery. It becomes a race to the vault. Get your metal out before there's no metal left to get. This creates exactly the kind of delivery surge that the force majeure was supposed to prevent, which then makes the force majeure inevitable. It's a death spiral. And Friday's margin hike was designed to prevent this spiral by making sure fewer retail investors have contracts to demand delivery from. But it might have come too late. Now let's talk about what happens to price in this scenario. Right now, there are effectively two silver markets operating simultaneously. There's the paper market, the Comex futures, the ETFs, the derivatives, where silver is trading around $84. And there's the physical market, the coins, the bars, the actual metal, where premiums over spot have exploded to $15, $20, even $30 depending on the product and the dealer. In normal times, these two markets trade in rough alignment. The premium on physical might be $3 or $4 to cover minting, shipping, and dealer margins. But when premiums blow out to $20 or $30, that's the market telling you that paper and physical have begun to decouple. The price on your screen and the price of actual metal are becoming two different things. What we're about to see is the complete separation of these markets. I'm not talking about a temporary premium spike. I'm talking about a permanent bifurcation where the paper price becomes increasingly irrelevant to anyone trying to buy or sell physical metal. Here's how this plays out. Monday morning, if Comex delivery problems become public knowledge, physical premiums will surge even higher. We could easily see premiums exceed 50% over spot. That means if Comex is trading at $84, you're paying $125 or more for an actual ounce of silver, and that's if you can find it, because dealers will be pulling inventory, waiting to see where the real clearing price settles. This creates a black market in precious metals. Not illegal, but black in the sense that price discovery is happening in private transactions rather than on public exchanges. When wealthy buyers start offering significant premiums to secure large quantities, when industrial users start hoarding inventory against future supply shortages, when sovereign wealth funds start placing orders that can't be filled at any price, the official exchange price becomes fiction. Now, let's calculate the logical price target if this scenario unfolds. If the Comex declares force majeure, or if delivery failures become widespread, we're looking at a confidence crisis in paper precious metals that extends beyond just silver. Gold will be affected. Platinum will be affected. Every commodity market that operates on fractional reserves will suddenly be viewed with suspicion. When confidence breaks, capital floods toward whatever still has credibility. In the precious metals world, that means physical metal with actual delivery. The demand surge from that capital reallocation, combined with an already tight physical market, creates explosive price action. We saw a preview of this when silver hit $122 before the crash. That wasn't speculation. That was capital trying to get ahead of what's coming. If force majeure hits, if we see confirmed delivery failures, if the bifurcation between paper and physical becomes undeniable, silver will find a new price equilibrium based purely on physical supply and demand. Based on industrial consumption, monetary demand, and the available above-ground supply, analysts who understand the physical market have been quietly circulating targets of $150 to $180 per ounce by the end of the quarter. $150 to $180. And that's not a bullish moonshot prediction. That's the mathematical result of available supply meeting unrestricted demand without the suppressing influence of fractional paper markets. Remember, silver hit $122 while the paper market was still functioning. What happens when the paper market loses credibility? But here's the critical point that everyone needs to understand. That price target only matters if you can access physical metal. If the door to the physical market slams shut because dealers have no inventory, because premiums make it unaffordable, because sovereign buyers and industrial users have locked up available supply, then the price could be $200. And it won't matter because you can't get it. This is the binary choice facing every investor right now. Stay exposed to dollars whose purchasing power is being systematically destroyed, or secure hard assets before the opportunity disappears. And let's talk about that dollar purchasing power for a moment, because this isn't just about silver going up. This is about the dollar going down. Our government has imposed 14% tariffs across the board on imports. 14% is the highest level since 1946. Do you know what happened after the Smoot-Hawley tariffs of 1930? The Great Depression deepened, global trade collapsed, and the dollar lost massive purchasing power even though it was backed by gold at the time. 14% tariffs mean everything imported costs 14% more immediately. That's your electronics, your clothing, components in your car, materials in your house. Prices rise, and what happens to prices when costs increase? They don't come back down. This is a one-way ratchet on the cost of living. And here's what most people don't realize. Inflation is already running hotter than official numbers admit. Real inflation, the inflation you experience when you buy groceries, pay rent, fill your tank, pay insurance, is running somewhere between 8 and 12%, depending on whose calculations you trust. Now add 14% tariff costs on top of that. We're looking at an environment where the dollar loses 20 to 25% of its purchasing power year over year. Think about what that means for your savings. Think about what that means for your retirement accounts. If you have $100,000 in the bank today, in 12 months, that money might only buy what $75,000 buys today. You didn't spend it, you didn't invest it poorly, it just lost value sitting there because the currency itself is depreciating. This is the choice. Hold dollars that are guaranteed to lose purchasing power, or hold hard money that can't be printed, can't be debased, and maintains value across centuries of human history. Silver has been money for 5,000 years. The dollar, in its current form, has existed for 50 years since we left the gold standard. Which one do you think will still hold value in another 50 years? Monday morning at 9:30, when those markets open, we're going to learn whether the silver market can withstand the pressure or whether we're witnessing the collapse of the fractional reserve system for precious metals. We're going to learn whether exchanges can maintain control or whether physical reality overwhelms paper promises. We're going to learn whether the decades-long manipulation of precious metals prices can continue or whether mathematics finally wins. For those of you holding physical silver, understand what you have. You're not holding a speculation. You're holding one of the few assets in the world that can't be created by policy, that can't be diluted by printing presses, that maintains value regardless of what governments or central banks decide to do with paper currencies. For those of you still deciding, Understand the window of opportunity that exists right now. Physical silver is still available, premiums haven't hit 50% yet, dealers still have some inventory. That might not be true 48 hours from now. When the Comex problems become mainstream news, when delivery failures start getting reported, when the premium gap becomes too obvious to ignore, the physical market could effectively close to new buyers for weeks or even months, while supply chains attempt to catch up. The final warning isn't about fear or panic, it's about awareness and preparation. The financial system we've trusted for decades operates on assumptions that worked when supply chains functioned, when global trade was cooperative, when fractional reserves went unquestioned. Those assumptions are breaking down in real time. The institutions running the system know this, which is why they're taking emergency actions like Friday's margin hike. You have a choice. Accept that choice. Make it consciously rather than by default. Because Monday morning, when Asian markets open Sunday night, the convergence begins. The paper market meets physical reality. The mathematical impossibility of Comex inventory ratios meets actual delivery demands. The global boycott meets the silver supply chain. And somewhere in that collision, the price discovery mechanism that's governed precious metals for decades either adapts or breaks. Stay informed. Stay prepared. And remember that in moments of financial upheaval, those who understand what's happening before the crowd always have options that disappear once everyone else figures it out. This is one of those moments. The numbers prove it. The institutional actions confirm it. And Monday morning will reveal whether we are witnessing just another market event or the fundamental restructuring of how precious metals are priced and traded in the modern world. Thank you for staying with me through this analysis. I'll be monitoring the markets closely as Sunday night approaches, and I encourage all of you to do the same. This isn't financial advice. This is financial awareness. And right now, awareness might be the most valuable asset you can hold.